Good evening, class, and welcome to our performance management class this evening. We are looking at the topic transfer pricing. Now, transfer pricing was discussed extensively in the last class. And so today we will be doing some questions, past questions and answers. So first off, we are looking at question number 6 on May 2016. This should be our 17th or 18th class. So let me call this assignment. I will just say A is not assignment. So let's call it A18. So this is the one we are solving. Question number 6 on May 2016. So that I'll get the question right now, then we will begin our solution. Okay, so questions will be loading now. May 2016. Okay, May 2016. All right, so good. The question is now open. So let's look at question number 6. Now, question number 6 is talking about mainly, this is not too much of a transfer price, but if you look at it here, Niger Power Electric Authority has two divisions, generation and distribution. The generation division has enough market even at full capacity of 5,000 megawatts of electricity. The distribution requires 2,500 megawatts to meet the demands of customers on its network. The power generation has the following selling price and cost data. Market price for 1 megabyte is 200,000. Variable cost for 1 megawatt rather, 160. Contribution is 40. Then the fixed manufacturing cost is 200,000. Now they said each megawatt sells for 250,000. Variable costs include work cost of network support, 500,000, and selling of 2% of sales. Capital investment by head office in generation amounting to 100 million. Advise the management whether to buy from generation division if transfer price is based on full cost basis. Then you see the second one here, advise whether the company as a whole would benefit if the divisional manager decides to buy from generation division at full cost basis. Then you see here, calculate return on investment on generation division. We've not learned that, so we'll leave that. Residual income, we've not learned that. How the division performance can be measured, we will not do the B part, so we are doing the A part. Now we are asked here to advise advise the management whether to buy from the generation division. So generation is the selling. So generation is the selling, right? and advise whether the company as a whole would benefit if the distribution, that is the buying, decides to buy from generation at full cost basis, whether the company as a whole will benefit. So look at it now. They have two divisions. Generation, these are the people that generate the power. And when they generate, they sell to the distribution that sells to, sorry, is buy, I want to write, that sells to the outside world. So this is the buying, okay, buy. Now, distribution requires 2,500 to meet its demand from its network. So distribution is still the buy. They require this to meet their demand. Okay, so this fixed cost, now each megawatt is sold for, so that means this is the megawatt that is being sold by the distribution. And look at the other expenses that are being made by the distribution. So we're asked now to look for if the generation should buy from, sorry, if the distribution should buy from the generation. All right, so that's what we are going to do now. Okay, so now this is what the department should do. The decision now is if the selling division, if the buying division should buy from the selling division. So the buying division will only buy if there is going to be a contribution, or if there's going to be a profit that will be made. Okay, so let's go now. This is performance management class. Topic: transfer pricing. I can past questions. So this is what we are doing today. All right, so we are solving, the first one is May 2016, question number 6. Okay, so the name of the company we are told is Niger Power Electric Authority. And that's another way of saying NEPA, but Niger Power Electric Authority. All right. Niger Power Electric Authority. I'll call it NPEA. All right. That's the name of the company. And now the 1A, okay, A part, A1, want to decide if generation should buy from if generation should buy from um, if generation should buy from the distribution at full cost. So A1 to decide if generation Okay, sorry, if division, sorry, is if division, I keep confusing these names. If division should buy from generation at full cost. If they should buy at full cost. Okay, so what is the full cost? So we'll say now full cost transfer from generation to division. I can see some comments. Let me see if I can see the comments. Distribution. Oh, sorry, distribution. Sorry, distribution. Distribution. Thank you. If distribution, thank you for that. Something was, I was thinking another thing and writing another thing. Distribution. If distribution, we use the same color. If distribution, all right, so it's distribution. So let's see. The distribution. All right, so now what is the full cost? We were told here that for the selling division, which is this is the selling, this is the selling. So all these are for the selling. This is for selling. All right. So now variable costs from generation. So generation will have this variable cost, and that is how much? 160,000. So this is 160,000, right? That's 160,000. Then this is per megawatt, right? This is per megawatt. And um, this is per megawatt. Then this is if we are buying 2,500, if the okay, so this is per megawatt, right? Now this is the fixed manufacturing cost. The fixed manufacturing cost is not going to the fixed manufacturing cost is not going to affect it, because okay, so let me see the best way to solve this. Okay, just a moment. I'm thinking of the best possible way to solve this. All right, so we are looking at full cost. Full cost here is either, this is market price that it is being sold in the market. We are giving here variable cost per megabyte. This is the variable cost that is being used here. Then we are looking at full cost, means fixed cost and variable cost. Now we are having fixed cost here. We are not told if this fixed cost is per unit or per megabyte. So we will assume that it is not per megabyte, it is per for the whole generation department. So what we will now do here is we'll go back here. Sorry, we'll go here. Variable cost here is 160. This will be transferred. Fixed cost is going to be 200,000. That is all that is being generated. Then the capacity is 5,000. So let's see how much 1 megawatts will take. So 200,000 divided by 5,000. So we are looking at the cost per megabyte. So what we have here is, what we now have here is 200,000 divided by 5,000 megabytes. That is like 40. So this is like 40 per megabyte. So this is 40 naira per megabyte. So is there any other cost again that the generation is only having this cost, 160 and 200? So no other cost is being mentioned for generation. So what happened now? This will now become 160,040. This is your full cost. This is your full cost. So this is the cost that will be transferred to the selling division or to the buying division. And so now when the buying division buys it, look at what will happen. Now this is the buying division, which is distribution. All right. So what will happen if distribution decides to buy from this? So this is their sales revenue. Sales revenue. How much is the sales revenue is going to make? It needs 250 megabytes. It needs 250 megabytes. So that's like, let's say selling price 250 megabytes is the total quantity they are buying. But before we go to the quantity, they are selling it for 250,000. So let's look at the selling price sort of sales revenue first. So this is selling price. Selling price, that's 250,000. Now the next thing is transfer price. Transfer price, we said it was 160,040. The next thing again is variable costs, other variable costs. So we say other variable costs or variable costs. This is variable cost of generation. It includes support, 50,000. So here is 50,000. Then again, it also includes 2% of sales. 2% of sales. So we'll come here. Okay, so this is support. 2% of sales. So 2% today will give me 0.02 times 250,000. So that's what 2% of the sales. 0.02 multiplied by 250,000. That will give me 5,000. So that will give me 5,000. Which other cost again? I think that's all. This is capital investment by the head office in generation amounting to this. This is capital investment that will be used to answer the part B question. So we see all the cost has been taken care of now. So let's see what the cost will be per megawatt. Why do I keep calling it megabytes? So I have 5,000 plus 50,000 plus 160,040. I have 215,40. 215,040. So this happens to be the cost. So you see, it's selling it for 1 unit as 250. Look at the transfer price, it's a variable cost, and look at the other variable costs. So if it removes this variable cost from the selling price per unit, so this is the contribution. This is contribution per megawatt. So what is the contribution? We have removed this from 250. And we're having 34,960. So this is 34,960. Okay, so advice. Distribution should buy from generation and make a contribution of 34,960 per megawatt. So that's it. So that's it, yeah. So this is the full cost that will be transferred. From this question, we see that 200 here is the market price. Market price is different from full cost. Variable cost is 160. But if you look at the ICANN study pack, they used 200 in their own solution, and they have a different advice and say do not buy. But when I checked, the 200 that was picked is market price, and the question is asking based on full cost basis and not based on market price. So that suggested solution is not correct. So based on full cost, this is 160 is a variable cost. Then fixed cost, we are not told if this is per unit. If it were to be per unit, it would have been stated. So this is the total fixed cost. If you want to divide it by the number of megabytes generated, it means 1 megabyte will be having 40. I keep calling it megabytes. For 1 megawatt will be having 40 naira of fixed cost. So that's how we got our 160/40. Now, the second question is asking, advise whether the company as a whole would benefit if the distribution manager decides to buy from generation division at full cost basis. If the company as a whole will benefit. Okay, so what will the company as a whole benefit from? So if you look at it now, there's the way we did that from company as a whole. So the second part of the question is B. Okay, A2. Will company benefit if distribution buys from generation? So that's the question we are asking. Okay, so this is the selling, this is the sell, this is the buy, and this is company. So sell is distribution. Sorry, sell is generation. Sell is generation. Buy is distribution. Okay, so what will happen now is this. External sales. Okay, what is the external sales? Now you see here that 5,000 megawatts is being generated, but distribution wants only 250 and 2005, right? So what will happen is this. This 2005 will be sold at full cost, and the other 5,000, the other 25 remaining will be sold at market price for the market. So look at what we are going to do. So we can say external sales. I will say to market, we have 200,000 times 2,500, because half of it is going to the market, half of it is going to the selling division. So 2,500 multiplied by 200,000. That will give me 500 million. So that will give me 500 million. All right. Then this is now this one, I'll put dash here and I'll put 500 million here. Then to buying division. Buying division, that is internal. Okay, no, this is external. We are talking about external. So let's leave internal first. External. Now, the buying division, when they buy their own 2,500, when they buy their own 2,500, how much will they sell it? The question says they are going to sell it for 250. So what we are going to do here is to market again 2,500 times 250,000. So now this time it is the buying division that is selling it to the market 250. So we have 250,000 multiplied by 2,500. That's 625 million. So this is 625 million. So 625 million. So let me explain here. The external sales from the generating division, they are making 5 million and 5,000. Half will go to the buying division and half will go to the external market, right? The external market price will be at 200,000 and they're selling it for 500 million. Now, the buying department, when they buy from this selling department, they are going to sell their quantity at 250,000 each. So now what we have dealt with now, we have dealt with external sales. So let's come for internal sales. Internal sales. The internal sales is the transfer price. Transfer. So it means that the remaining 250 that this selling division, it has only sold to the market. So it is going to sell at 160,040. So this is what the internal sales will look like. 250, 2,500 times 160,040. That will give me 400,100. So this is 400,100. So if you notice, here will be dash and here will be dash because it is transfer. So we will now look at what is their total. This will be 500. This will be 1 billion and 0.25 100. While this will be 6 plus 5, 11. 1 billion 125. All right. So just a moment. Let me start. Let me this like this some costs. Costs. So let me look at variable costs now. So the first one is transfer price. So I beg your pardon, I've made a little mistake. This figure should be here. It is these people that sold it 400, 100. And this figure here should be 625. And this figure should be 900, 100. 900, 100. So nothing happens to the total market. So now the transfer price is a cost to this company here. So this will now be 400, 100. That will be dash. Then the next one is variable costs. Variable costs. So now the variable cost here is 160. So here I will say variable cost. Variable cost. Now let me say selling department. The selling department will be 160 multiplied by 5,000 megawatts. That is the variable cost to it. So 160 times 5,000. That will give us 800 million. So here is 800. Then let's put 800 here. All right. Then the next one is, which other variable cost do we have? All right. We then have variable cost buying division or department. So what are the variable costs that we looked at? The variable cost we got was 215. Okay, apart from this transfer price. So it is 50 plus 5, as is stated here. 50 and that 5,000. So that's what will be our variable cost. So it is going to be 55,000 times 2,500. Okay, so 55,000 multiplied by 2,500, that will give me 137,500. 137,500,000. So that's what I'm going to put here. So the variable cost is finished. So let's see if we can get a contribution. Okay, so let's get total variable costs. See, total variable costs. Variable costs. So here will be 800 million. Here will be 500 and this is 537,600, and this is here 937,500. All right, so that's your variable cost. So now let's look at the contribution. So these are contribution. Our contribution here, this is going to be, this is 900, this is 800. So this is going to be 100, 100. So this is going to be 100, 100. This is 537. This is 625. So let's do it. 625 minus 537,600. And that gives us 87,400. And let's do this other one. This is 1125,000,000 minus 937,500, and that gives me 187,500. Now, incidentally, if you add these two, it gives you this. This is 87, this is 100, that is 187. 100 plus 400 is 500. All right, so we are making a contribution here. Then if we add our fixed costs, the fixed cost, we are told our fixed cost here is 200,000. 200,000. So this is 200,000. So this will be 187,300. So this is our profit. Advice: the company as a whole will benefit if the distribution buys from the generation. Contribution will be equal to 187,500, and net profit will be equal to 187,300. So that's how this question is going to be solved. So you can see the clear way that this was solved here. Although this power generation was calculating its contribution based on market price here, 40, but you know, all of them were not being sold at market price. So the ones that are sold at market price gave us this contribution. The one that were sold at full cost gave us a particular price. You also notice here that this fixed cost is only borne by the generating department. Fixed manufacturing cost is the manufacturing cost here. It's being borne by the other departments because they are the ones that are using it to generate, to generate electricity. So it's borne by them. All right, so we have done that. So in the first instance, do not buy. If it is looking at it from the selling, from the management point of view, from each of these management point of view, we are seeing here that, okay, buy. We are told that they will still buy. If you're looking at it from their selfish point of view, they should buy from their generating department. Then from the company's point of view, they are still supporting that they should buy. So that's how this question is being solved. Now let's look at another question in transfer pricing. Okay, we look at question number 7. This another one here, A18. Let's look at May 2017, question 7. May 2017, question 7. So I'm getting it opened now. May 2017, question number 7 is coming. May 2017, question number 7. All right, so let's look at this question. It says here, Adabel Nigeria Limited manufactures 2 motorcycles. The company is split into 2 divisions, the assembly division and the engine division. So assembly division is A, engine division is B. So division E supplies engine to division A. So here E is sell, A is buy. The 2 divisions run as autonomously as possible, subject to the group's policy. That is one thing we should know, that you should know the group's policy. And the group's policy is that E must make internal sales first before selling to the outside group. And that A must always buy from E. However, this company's policy, together with the transfer price which E division charges A, is currently under review. Details of the 2 divisions are as follows. So this is A, is the buying division, and this is E, the selling division. You have to be putting these things with your pencil. Division A budget for the coming year shows that 45,000 engines will be needed. An external supplier could supply this for A for 80,000 naira each. So external people is saying they want to sell it for 80,000. So what do you think will make A happy? If A gets it less than 80,000 or nothing more than 80,000, it will be happy with E. But let's see what E is going to do here. Division E has the capacity to produce 70,000 engines for the year, and these people are taking 45. So let's look at something here. 70,000 minus 45 will give us what? Let's use our calculator to be doubly sure. 70,000 minus 45,000 should give us 25,000. This calculation is very important. This is because if these people can produce 70,000, 45 must go to the selling department, to the buying department, because the policy is that A must buy from E and E must first sell to A. So that means 25,000 is available for the external market. All right. Now, details of E budget which has been prepared for the forthcoming year are as follows. Budgeted sales unit 70,000. Selling price per engine for selling price per engine for external sales. Okay, this is the external sales, not internal. They are selling it for 85 externally. Then variable cost per unit for external sales of engine is 77. The variable cost per unit for engines sold to division A is 3,000 naira per unit less. Now they said the variable cost per unit sold to division A is 3,000 naira less due to cost savings on distribution and packaging. Now what it means is this. Look at this variable cost. This is 77. Normally, packaging and distribution is supposed to cost them 3,000. And so everything should have been 80,000. Just the same 80,000 that these other people are offering to pay. But these people will now package it and will now distribute it. But because they are in the same department, they are the same compound and all that, they will not need to put a package, they will not need to distribute. And so they are saving this 3,000 and it is 77 that is the variable cost. All right. Maximum external market demand is 35,000 units. So now you see what is available is 25,000. But what market demand, the maximum they want is 35. So you can give them 25, you can give them up to 35 units per year. Now, we are asked to recommend the transfer price or prices at which the internal sales should take place. The transfer price or prices that will that the internal sales will take place. So let's see how we can solve this. Just a moment. Okay, so what will happen here is that I said before that for transfer price, okay, let's look at this question and put the appropriate question. 2017 May, question 7. May 2017, question 7. And the question name is Adabel. Sorry, this is not the question here. Question here is Adabel Nigeria Limited. Adabel Nigeria Limited. Okay, Adabel Nigeria Limited. Now the question is the transfer price which this internal sale should take place. So A part, transfer price for internal sales. So now the thing is, what is the transfer price for internal sales? So now you look from the group's perspective. Let me go back to the question here. From the group perspective, each time they are, is it from the group perspective here? From the group's perspective, anytime that an engine is being sold, the E department, which is the engine department, generates a profit. And each time the engine is being sold, the full vehicle is being sold, Division A also makes a profit. Okay, so let's look at what will motivate each of them. Looking at the selling department, let's look at the selling department first. So if it sells at 80, if it sells at how much here? Selling price per engine for external sales. So this is the external sales, but variable cost. It's a variable cost for engines sold to E is 3,000 naira less. So it's supposed to be 80,000. So it means that we will say engine department, which is the selling. So this is the sales price. We have 77. This 77. No, they said this is the variable cost per engine. Oh, okay. Just a moment. Okay. So the transfer price that okay, so this is the sales here for division E. What is the variable cost? Variable cost. The variable cost here, we are still told, is going to be 77. So it's going to still be 77. So the sales, because it's selling it at variable cost. So if you look at it now, it's selling one for variable for 77 for 77. So for each time you are selling For each time you are selling to the internal market, you are selling it at variable cost. You're selling it at variable cost. But if you are selling to the external market, you are selling it at 85,000. So it means that for the internal sales, there is no contribution. And so this makes 77,000 to be the floor. So this is the minimum that it can sell. Then to the buying division, is the buying division, which is assembly. Let's look at their own. In the buying division, they are going to buy 45 and external supplier can supply them at 80. We are not told how much they are going to sell. How much they are going to sell is not being told. So we don't know how much division A is going to sell. Division A is going to sell there is no amount here that division A is going to sell. And so what happens here is that they have a market price they want to buy, 80,000 naira. And so, and there's also sales at the market price, 85,000. So division A can either buy at 77,000 or 80,000 or 85,000. So this is the list that they can sell, that they can buy from this. They can as well buy, if they decide not to buy from A division, they can go outside to go and buy, or they can buy at market price. Because this is a certain supplier said is going to supply them this, so they can buy at this price, or they can buy at 85,000. So the transfer prices will be between 77,000, which is a list from the selling price, up to 85,000, which is the market price. So that's just this. So the transfer prices will be either 77, which is a list, or 85,000. Now they said here, assuming that the group's current policy could be changed, using suitable calculations, the number of engine which division E should supply to division A to maximize group profits. Okay, so assuming the group decision can be changed. Okay, so the group division could be the group policy could be changed. So let's say now the B part, if group policy changes. Now, if group policy changes, it means selling division. So let's see selling division. So selling division will decide to sell. They will sell now first. They will sell first to external market. So you see here, external market They will sell at 85,000 times 35,000 units. Then they can decide to, because internal market now, if somebody is asking a question, why not recommend the least transfer price instead of 77 or 85? Did you see the question? It says, what is the transfer price or prices at which the internal sale should take place? If we sell at 77, that is the least. It will not make the selling division happy, because if you see our calculation, it is not making any contribution. I forgot to write contribution. It is not making any contribution. But it's not making any contribution. Any loss, any fixed cost it has, the loss it will make in that department will be equal to the fixed cost. So, but we learned last time that this is the list of the transfer price. Then buying division, we are not told the price that they are going to buy, they are going to sell. We are only told that somebody can supply them at 80. So if somebody can supply them at 80, selling division could say, okay, instead of me selling at 77, why don't I sell it at 80? Or if you decide that you want to go to the market to go and buy, or they want to sell it at market price for you instead of this price, that is why we are saying it's either going to be 77 or 80 or 85, because these are the possible prices that it could be transferred. It can never be transferred below 77 and never above 85. Now, if the group policy could change, so it means that the selling division can sell to external markets, and this is what they are going to make here. Let's do the calculation now. It will sell 85,000 multiplied by 85,000 multiplied by 35,000. That is going to be 2975. 2975. So this is your sales, external sales. Then internal sales. It will now be, they can decide to sell at 77,000 multiplied by, how many will now remain out of 70? We are told that these people need 45. They need 45. So you now have 35. So let's see. 77,000 times 35. That will give you 2695. 2695. Then external supplier. So it means that the external supplier is bringing it for 80,000 and they are buying the remaining 10,000, because these people can produce only 70,000 and internal need 45. If they sold 35 to the external market, only 35 will be left. So they have to augment the 10 from outside. So this will give you 10,000 times 80, 80,000 multiplied by 10,000. That will give me 800,000. thousand, 800 million rather. So it means that these are the things that the division, this is division A, this is division A, this is division E. Division E is selling this outside. Division E is only selling this externally, internally. It's going to sell this internally. But now the thing here is this one here that is being sold internally does not affect the group's profit. So this does not affect the group's profit. So the group's sales or the group's, okay, sorry, I've done something wrong. I should have used contribution. So let me take this back. Let me take this back. Should have used contribution. Okay, so let's use contribution. So external sales. The contribution is going to be 85,000 minus 77,000, which is how many? Which is how many? 85,000 minus 77,000. That will give us 8,000. So this is 8,000 multiplied by how many is being sold externally? 35,000. So 35,000 times 8,000, 8,000 times 35,000. That will give us 280 million. So 280 million. So this is a contribution from external division. So it can sell the engine to the 35 it can make. The remaining one is going to make is going to sell it internally. Now, internal, okay, buying division. Buying division. Now, the buying division, am I writing external sales? External contribution. So, say contribution. I will now say external contribution. Now, normally it's taking the remaining 35,000. The remaining 35,000 that is taken from this division will not affect the group because it's going to cancel out. It's going to cancel out. It's not going to affect the group. So we are not going to use that. The only one we are going to use is that 10,000 that is going to buy from outside because normally it needs 45. 35,000 has gone to external, 35 is coming to it. As it is coming to it, it's coming as a revenue, but it will not affect the group because it's transfer. It doesn't affect the group. What only affect the group is the external ones that was collected from outside and then sold. Normally, they are going to collect 45 and they are going to sell the whole 45. 35 out of it is not going to affect much because it is at transfer price. Okay, but we can still show that. We can still show that But what is here is that 10,000, that 10,000 that was, so it's going to be 80,000. We bought it at 80,000, and the variable cost is 77,000. The variable cost is 77,000, which happens to be 3,000. Now the 3,000 multiplied by the 10,000 units that was bought outside will give us, it's going to give it 30 million or 3 million. Let's say 10,000 multiplied by 3,000. That will give us 30 million. So that will give us 30 million. So what will now happen is that group contribution will now be 280 plus 30. 280 million plus 30 million. That will give us 310 million. So that's it here. So assuming that the group's policy should be changed, using suitable calculations, calculate the number of engines in which division E should supply to division A in order to maximize group's profits. So now look at the group's contribution, 3 million. So it means that, how did they achieve this? Division E sold 35,000 to division, okay, division A, let me call it div A, and they sold 35 to external. So that is what achieved this. Then division A bought 35 from division E, and they bought 10,000 from, what's the name of that supplier again? From, what's the name of that supplier? External supplier. They didn't give the name. From outside. So it means that to achieve maximum profit, division division E, yes, should supply 35,000 engines to division A instead of 45,000. Normally, if the group's policy was to be followed, division E must give 45 to A and 25 outside. But now, it must now have to satisfy outside first because it's getting more profit from outside. It's going to get more profit from outside. And so the remaining 35 to give it to division A. And so division A will still now buy it and go and source the remaining 10 outside. So that's what this calculation is saying. And so if you can see now, this is the maximum contribution that it can get. Sometimes transfer pricing questions are usually tricky. You need to be conversant with transfer pricing questions for you to do well. Let's look at another transfer pricing question. Let's look at 2019, question 5. 2019 May, question 5. 2019 May, question number 5. Is it question 5 also? Let me see again. Question 5. Okay. I think, sorry, I didn't open it with the right, open it where you see it here. All right. Question number 5. What's this? Ah. Uh-oh. Let me see. Okay, so this is the question. TK is a company that produces toy television sets targeting children of the elite. The company has two divisions, Division S and Division B. This is simple. Division S manufactures components for the television and sells components to Division B and to external customers. Division B uses 5 of the components in each of the television sets that it manufactures and sell the television sets directly to external customers. So look at the budget for the selling department, direct material, direct labor, per component. This is per component, variable overhead. The following information is related to next year. Look at the fixed cost. Look at the production capacity, 175. External demand, 150. So if you less 150 from 175, what will you get? That will be 25. So this is 25. So 25 is what is available if you are to satisfy external market first. 25,000 will not be available to the internal market. Now, potential demand from Division B. But Division B is likely asking for 80. But what is available seems to be like 25. There are going to be problem. Then anticipated market price for the component is how many here? 500 naira. Now look at the Division B. It sells at 4,500 for the television. Then Budgeted variable material manufacturing cost per TV as direct material, direct labor, variable overhead. In addition to the variable cost above, each toy television set produced needs 5 components. So the 5 components will be at 5 times transfer price of one component. So transfer price of one component times 5. So fixed costs are budgeted to be this for 1 year. Annual sales of the toys is 16,000 units. So if they are going to sell 16,000 units, now see something now, 16,000 units of television, and you need 5 components to make one television. So how many components will you have? 16,000 multiplied by 5, that gives us 80,000. So this is 80,000. And this is the 80,000 that they are asking from. 80,000 because they have budgeted to sell 16,000 units. Now, look at the policy. Transfer price is set at opportunity cost. What is opportunity cost? Opportunity cost here means that if S have to satisfy B over the market, it means that the quantity in contest between the market and B must go for the market price if the market price is higher. Now they said S must satisfy the demand of B. So this is must satisfy B before selling the components externally. And B is allowed to purchase components from S or from external supplier. So assuming that division B buys all the components it requires from S, prepare a profit statement for each department detailing costs, sales, showing external sales and internal supply separately where possible. Okay, so now this is what you are going to do. This is what's the question name? TK is a company. So I'll come here. The next question here is ICANN, May 2019. Question number 5. Question 5. And this is TK. The A part is saying profit statement for each division. So we say A, profit statement for each division. What is the profit statement for each division? So you will need to now get the divisions now. So we have division S, which is the selling. Then we have division B, and perhaps you can put group. Okay, so we'll start with external sales. Now, let's start with division S. We are told here that division S, division B must buy from S. S must satisfy B before selling out. So what happened here is B need 80 components. So what happened? I'll do something like this. This is S. This is B. This is market. So S is supplying to the market. S has 175,000. So if it gives 80, what will go here is how many? Okay, so now these people needs 80 and these people needs 150. Okay, so because these people needs 150 and these people needs 80, so look at what I will ask you to do. 80 plus 150, that's 230, right? 230. If B is asking for 80, market is asking for 150, that means they're asking S to produce 230, but it cannot. It can only produce 175. So that means 55 is going to short. So assuming we short 55K here and short 55K here, how will it look like? Okay, I should be doing it in this bigger place. Let me, okay, I should have done that before I did this. Let me do that here as a preliminary workings before I do this. Okay, so I have S, I have B, I have market. They can only produce 175. This one is asking for 80. This one is asking for 150. If you add them together, you have 230. If you add the two of them together, you have 230. So the difference is 55,000. That's the difference. So if I say 80K minus 55K, what will happen here? 80,000 minus 55,000. That means 25,000 here. That means 25,000. Then I have 150. 150 minus 55,000. That's 95. Okay, so let's look at what happens here. What's the essence of this diagram? This is 150 minus 55. Now, what's the essence of this diagram? This is the essence. S can only produce 175. So because it has 175, sorry, it has 175,000, and there is a imbalance. It cannot satisfy everybody. It will give out 25,000 to division S first. What will remain is 150. Instead of giving the 150 to division market, it's going to give it 95. And what is remaining is 55. Now, this 55 will go to division B. So that's this 55 here. This 55 is what is in contest between S and between B and the market. 25 is not in contest. 95 is not in contest. So if you look at it now, 25 plus 55 plus 95 gives me 175. But you see here, 25 will go at what's the transfer price? Will go at the transfer price. What is the policy? Normally they didn't tell us that we should transfer at full cost, at opportunity cost. Okay, at opportunity cost. The anticipating external price is 500 naira. That's the market price. Okay, how much is being said here? If you are going to add material, labor, and variable overhead, let's see, material, labor, and variable overhead, how much is it going to be? 140 plus 180 plus 120. That's 440. That's 440. So that's all these are variable costs. All right. So if they are transferring at the lowest cost, it means that this 25 will go at 440 naira. Whereas this 55 that is being given to B will go at 500 naira. And this 95 being given to the market will go at 500 naira. Because market will buy at market price. Meanwhile, S is being given priority to take the whole 80. 55 plus 25 is 80. So this 80 they are going to take, they're not going to pay all 440. They are going to pay for only 25 that is not in contest at 440. But this 55, let me write it well, this 55 that is in contest, they are going to buy it at the market price. So this 55 is going to be sold at 500. So that's the first thing you're going to do now. Then I will start and say this is division S, division B, can say group. So you can now say external sales. So division S is selling 95,000 components. So we can do here and say 95,000 components at 500. How much would that be? 95,000 times 500. That will give me 47,500. So that will give me 47,500. Okay, this for components. Then this external sales. Then the television that division B, the television that division B will still sell. How many television is making? 16,000 units of television. That is what is being sold to the external market at 4,500 times 4,500. That's the external sales. 4,500. So 16,000 units of television multiplied by 4,500. That gives me 72 million. So that's the external. So external, S will sell 95,000 to external. The buying division will sell its television 16,000 to the external. Then now internal sales. This is the transfer price. Now it means that internal will just be, it's not going to be the whole 80,000. Normally it's 80,000, but they are going to be different prices. 25,000 will be at 440 naira, and 55,000 will be at 500 naira. So that's going to be the internal sales. So let's calculate 25,000 times 440. That will give us 11 million. So this is going to give us 11 million. Of course, it's going to be dash here and dash here. Then we have 55,000 multiplied by 500. That's going to give us 27,500,000. 27,500. So that's going to be dash dash. So all the sales is done. So we'll calculate total sales now. So let's calculate total sales. Total sales. Let's do that of let's have this one. We already have 27,500,000. We just add 11 million to it. Then we add 47,500,000. That gives us 86 million. So 86 million is what we have here. Whereas the external sales here is 72 million. No, total sales rather, 72 million. And here, total sales is 47,500,000 plus 72 million. That gives us 119,500. 119,500. All right. Now let's go to costs. And let's start with variable costs. Variable costs. And we have here in variable costs, we have, okay, the first thing in a variable cost we should do here is, okay, let's start with transfer price. Let's always start with transfer price as a rule. Costs, we have transfer price. Now, this is the transfer price. So it's buying everything here. So if you add these two, these are the things that are being transferred. 11 plus 27, that should give us 38,500. So here is going to give us 38,500. It's going to be dash here, it's going to be dash here. So how do we get 38,500? It's just the addition of this internal sales. These two internal sales. So what gave us the transfer price. All right, so The next one is variable costs. So now let's see. In our variable cost here, we already got 440 here, 440. So we'll simply say 440 multiplied by 175,000 that it produces. Because everything it produces, it must spend that variable cost. So 440 multiplied by 175,000. That will give us 77 million. So this is 77 million. Of course, this will be 77 million. Then the same thing for the other one. We have, let's add this up. 600 plus 400, that's 1,000. 1,100. 1,180. This is 80. 6 plus 4, 10, 11. 1,180. So that's what we are going to use. 1,180 multiplied by the 16,000 units of television. So we have 1,180 multiplied by 16,000 units of television. This is 18,880. 18,880. 18,880. So you see here, this transfer price here is for components. As you can see here, Division S is selling components to outside and selling components to inside. This 80,000 units here is what was used in making this 16,000 outputs. So it means that this component that was transferred is the cost of 16,000 units. The component cost for 16,000 units. And this is the other variable cost for 16,000 units. Okay, so what other cost do we have left? We've taken the variable cost and the fixed, we have not talked about the fixed cost. So let's leave the fixed cost now. So we'll come now here. We want to get total variable cost. So let's rule line here. Now say total variable cost. Total variable cost. So let's see. So this is going to be 77. Now this is going to be this plus 38,500. That gives us 57,380. 57,380. Now this is going to give us 77 plus 180, 18,880. That gives us 95,880. All right, so your contribution now, this is contribution. How much is the contribution? 86 minus 77. maybe I should do the last one. I have 95,880. Let me put the minus before it first. I'll now remove it from 119,500. That gives me 23,620. 23,620. All right. So let's do here 86 minus 77. 86,000 or million minus 77 million. That gives me 9 million. So this is contribution of 9 million. Now let's look at this one here. 72 million minus 57,380. That gives me 14,620. So this is 14,620. Now, if you were to add 14,620 plus 9 million, it gives you 23,620. So you see here, why your total sales will not, the two divisions total sales will not give you the group's total sales because of this internal sales, and the two groups total variable cost will not be the sum of these two. When you have cancelled the transfers, their contribution, if you add the two groups, it will give you the third one. Then we have fixed costs. What is a fixed cost for division S is 5,600,000. 5,600,000. So this is 5,600,000. Then for the other one here, 14,600,000. So this is 14,600,000. So 14 plus 5 is 19. 20,200,000. 20,200,000. Let's be certain that is correct. So 5,600,000 plus 14,600,000. That's 20,200,000. That's fine. I have 20,200,000 already on my calculator. So if I minus that, okay, so sorry. If I spoil the whole thing. So let's do it from beginning. 9 million. What is happening? 9 million minus 5,600,000. That will give me 3,400,000. 3,400,000. So this is profit. 3,400,000. And I can see that this is 20,000. And so this should be, sorry, what's blocking me? So this should be 3,420,000. So 3 million is here. 6 minus 4, 6 minus 2 is 4, 20 here. So it's 3,420,000 for the group. So this is the profit statement they're asking you to do for the two departments. Now the B part says a specialist supplier has approached Division B and offered to supply 80,000 components at the price, so they are going to supply this 80,000. So what it means is that if they're asking them to supply 80,000, they have no need to buy from division E. So if you see the group statement, division S must satisfy the division B's demand before it sells to external. Now, division B is allowed to purchase component from S or from external market supplier. So here, in this one we did here, there was no market person approaching them. But now, a market person has approached them and said, look, oh, I'm going to give you the whole of your 800. At how much now? At 420 naira each. Remember, these people we are selling to them at 440, right? But somebody is telling them that, look, I can give you at 420. So division B could decide to buy everything from outside. And so division S has nothing to, offer to division S has nothing to offer to B anymore. All right, they said a specialist external supplier has approached division B and offered to supply 80,000 components at a price of 420 each. The components fulfill the same function as those manufactured by S. The manager of B has accepted the offer and has agreed to buy all the components it requires from the supplier. Now we are told to produce a revised profit statement for each division and for the total and for TK total. So you see, in the first instance, they told us to provide a profit statement of each division. They didn't tell us of the total. But you see here, it's always good to also provide for the total so that as we are looking at this B part, we are going to be looking at, yes, it's going to favor division B, but what is happening in the group as a whole? Because transfer pricing is the situation whereby a group is using this to improve its overall objective. So what is happening to the group? So we'll come back again. I'll be using a different color now. Let me use this color for this. So I will start again. So this is the B part. B buys from external supplier at 420. So this is division S. This is division B. And now this is group. So what happens now? External sales. External sales. Now in the external sales, because B is no longer buying from S, S will sell the whole 150 that the market needs. It will sell the whole 150 that the market needs. So it's going to be 150,000 at the market price. What's the market price? Let's refresh our mind. 500 naira. At 500 naira. So let's see what's going to happen. 150,000 at 500 naira. That will give us 75 million. So we take it 75 million here. So the group will still be 75 million. Then external sales for Division B. Division B will still sell its 16,000 units of television at how much? The same price we had here, at 4,500, which will give him 72 million. At 4,500, that would be 72 million. 72 million. All right. Now, Division S cannot produce 175 anymore. Of course, its maximum production is 175, but because B has told them that they have accepted offer to buy their 80 pieces from outside, so there is no need for them to produce 175. Let them produce to satisfy only the market. And so they produce only 150. And so there is no transfer price here now, just only external sales, no transfer price, because nobody is transferring from anybody. So I will now say total sales, it should be 75. This is 72. 75, 75, 150, 150 minus 3, 147. 147 million. All right, so this is your total sales. Let me underline it because we are about to bring. Should I even underline? No, I don't need to underline because there's no transfer. So now we have variable costs. So the first variable cost, let's say this is for S. S variable cost will now be 150,000 multiplied by 440. That's how much variable cost they are having, 440. So the whole 150 multiplied by 440, that will give us 66 million. So it's going to be 66 million. So let's give it 66 million here. Then the B is going to be 16,000 multiplied by, we said before, we've done it before, 1,080,000, 1180. That will give us 18,880. 1180, 18,880. So this will give us 18,880. This will give us 18,880. So that's your variable causes for B. Okay, this is for S. So let me, it's where this V, this for S, this for B. All right. So let's look at their contribution. Contribution. So here, 75 minus 66. So I have 66 here. 75 gives me 9 million. Now, if you check well again, contribution was still 9 million. So you see, it has no issues. If you don't buy from me, no problem. If you don't buy from me, my contribution is still 9 million. So no problem. Go ahead, buy what you want to buy from outside. Now, everything now depends on the contribution of the buying division. So the buying division now, it has 72 million minus 18,880. This is 53,120 as against 14. So you see here, this is a whole lot. 53,120. So 53,120. So now let's look at for the group. You see the group's contribution will improve 147 minus 66 minus 18,880. That gives me 62,120. So if you look, 53 plus 9 is 62,120. Now can you check now? 62 versus 23. So you see here, this is a whole lot. So if you now bring your fixed cost, the fixed cost do not change, you put the same thing here, 5, 6, 14, 6. 5, 6, 14, 6. That should be 2,200 as before. 2,200. 2,200. All right. So the next thing should be your profits. 9. So this should be 4,400 as we got before. Or is it 3,000? Yeah. Yeah, 3,400 because 8 minus 5 is 3. 3,400. All right, so we have here, I have this on my calculator, so let me just say minus 2,200. That gives me 41,920. 41,920. So this will be 53,120 minus 14,600. That should give me 38,520. 38 plus 3 is 41. 5 plus 4 is 9. That's fine. So you see now this is the revise. So if you are to ask, if you are to be asked, which policy do you think will favor the group? So you see here, you were asked, provide a revised statement for each division and for the total, 5 marks. So you see here, it's best that they go and buy this 80,000 components at 420. Just a little 20 naira difference is a whole lot, brings a whole lot. Now the third one here says, S has just received an inquiry from a new customer for the production of 25 components. 25 components. Now, can you see here now? Can you see? It was producing 150 before. Now, if it is producing the extra 25, it means the whole of the 175 would have been made. Abi, 175 would have been made. All right. The manager of S division requires a total profit for the division of 4,500,000. Now calculate the minimum price per component to sell to the division, to sell the 25,000 components to the new customer that would enable the manager meet its target. They said, note, in order to, this order will have no effect on the divisional fixed costs and no impact on the 150,000 components. Okay, it will have no effect on the 150,000 components S sells to the external customers at 500 naira per component. Division B will continue to purchase the 80,000 components it requires from the external supplier. So now they want a profit here of 4,500,000, isn't it? That's it. So the next one here, I'll use a different color. So let's say this is C. What's the question of C? The minimum price to sell. Minimum price to sell 25,000 components to meet target profit of, how much is that? A total profit of 4,500,000. 4,500,000. 4,500,000. You see here, each time they were having profit of 3,400,000, 3,400,000. So now they want to profit of 4,500,000. So let's start. Target profit is 4,500,000. Okay, if this is your target profit, 4,500,000. Now let's remove fixed costs. You now say minus fixed. Okay, no, let's add fixed costs, because normally contribution minus fixed costs will give you profits. And so if you do it the other way around, profit plus fixed costs should give us our contribution. So plus fixed costs for division E. Is it division S? Yes, division S. Okay, is it division S we are looking at? Yes, division S. So fixed cost is 5,600,000. Five billion 600. So when you add 5 plus 6 is 11, 5 plus 5 is 10. 5 plus 4 is 9, 5 plus 1, 5 plus, okay, that's 10,100,000. So this is your contribution for division S. All right, so this is your contribution for division S. Now, we are told that it didn't stop. Okay, it didn't stop what we are selling for our other people. So, but now we have contribution, right? Now, normally we have sales minus variable cost gives us contribution. So if we are working back, if we have contribution, let's add variable cost to it. plus variable costs. Now, before we did 150 in this question, but now we are going to be doing the whole 175 because we are producing everything. 175 at 44, 440. So 175, the whole component, times 440 naira. We've calculated that before when we did the first one. We calculated it before. Where is it again? Yes. 175 times 440 will give us 77 million. So that's what we are going to use here. 77 million. Remember, this is 100. So this is going to give us 87,100. So this is going to be total sales revenue. So this is going to be the total sales revenue we have. But now we are selling to external markets. So if we remove the sales revenue we have for external markets, we'll be left with the sales we will have for that special customer. So we have revenue now, let's say minus external market sales. How much are we selling them? We're selling them 500 naira times 150. Okay, we've calculated that before. 150 times 500, that gives us 75,000. 75 million. So this is 75 million. Out of this 87,100, 75 million is for external markets. So this is therefore sales to special customer. So how much is it there? We have 87,100 minus 75,000 or million. That gives us 12,100,000. 12 million, sorry, 12,100,000. 12,100,000. So this is the sales we are to sell for the customer. Okay, so we know that sales quantity multiplied by, okay, so this is our sales now. We know that sales price multiplied by quantity equals to sales revenue. And now we want to know the sales price. Sales price will now be equal to sales revenue now divided by quantity. So we have our sales revenue here as 12,100,000. Then this other one is 25,000 units. So let's check it out. 12,100,000 divided by 25,000. That means 484 naira is the minimum, 484. So this is 484 naira. So minimum sales price to meet target target profit. So if you sell 484 naira to those 25,000 components, all things being equal, you are going to meet the target profit for that division. Anything below 484, you will not meet that target. Anything above 484, you will exceed the target. So that's why this is the minimum selling price to meet your target. And we have succeeded in doing the whole 15 marks questions. Okay, so I know that there are other transfer pricing questions that are here. I saw them, didn't want to go into that because it would take a long time. And at least I know one of them is here, so we can think about this. And there's another one again here. This. So there are two transfer pricing questions that we are yet to do. So let's just peruse them and see what it is. And if need be, we could do them in the next class as a part of continuation, or we could do that as an assignment for you. So let's see it again. So it will determine what we should do. So November 2018, question 2. November 2018, question 2. Let's see what it is. November 2018, question 2. Then we have November 2014, question 1. 2018, question 2. 2014, question 1. So this is 2018, question 2. 2018, question 2. Then 2014, question 1. So now I will ask you for your opinion right now. So let's look at these two questions. Okay. So both of them is almost the same thing. So for the sake of time, so that the video will not be too much, we are going to solve these two questions in our next class. But I want you to attempt them. I kind of saved these two questions for last. They seem to be tough, but by the time we finish them, it's going to be very easy. So in our next class, we are still going to solve these two questions, and if there is time, we enter into the next topic. Otherwise, these two might suffice for the day until you can see another question if need be, to make it 3 if it's possible that time can carry. So while we are taking transfer pricing this way, is because of the frequent nature in which these questions on transfer price appears in your exams. You can see a number of places where it is located. So it is very possible, a sure question, it's possible that out of the questions you are going to see in the exam, transfer pricing will rear its head. So we're taking time to make sure that you understand the basis of transfer pricing. So thank you so much for the time spent in this class. And if you have any question, feel free to ask and I will do the needful. So until our next class, when we are doing the two other questions, it's goodbye from me and see you again in our next class.